All right, let's talk some charts here as we get ready for a Friday that could have some action in store. Russell's hurting right now, down almost 1.5%. We've got bonds, a little change, and the dollar still catching a real strong bid. Joining us, Katie Stockton, to look at the charts. Founder and managing partner at Fairlead Strategies and portfolio manager at TAC. Katie, great to have you here on a Friday. So what'd you learn this week? One that had a lot of seemingly good inflation data.
That's right. The market did receive that data pretty well. The S&P 500 being very close to new highs, NASDAQ 100 included. Of course, we do have some divergences with the small and mid-cap benchmarks, which of course have pulled back a bit. And that does show that the breadth really just hasn't been there. It improved slightly this week, but really not enough to suggest that this rally can just continue to persist the way it has done. As you've seen with the mega caps, they just continue higher. It includes Nvidia. And now the newcomer to the party is Apple, of course, with its big breakout. So these stocks have done so well. And for the most part, they lack any kind of big sell signals. They still have good momentum. So they've been very key to sustaining the momentum behind the NASDAQ and the S&P.
So that's really important that you don't see the major mega cap players as being necessarily overdue for some big pullback. And we do have Apple chart up here right now.
Yeah, so Apple cleared some very important resistance around 198, and that was really kind of a big deal from a technical perspective. If that breakout holds through next week, we would be a believer of it. We always wait for confirmation of these breakouts. The measured move objective, which assumes that the trend will continue, would be about $240 for Apple. And of course, that is compelling upside even from here. So it is a big deal for Apple. There are no sell signals at this time. There are some signs of exhaustion in Nvidia, but not enough to suggest that it's a big pullback is imminent. The momentum, we wouldn't really want to fight that momentum, but certainly respecting it at this time.
Okay. And as it funnels up to the index then, given the concentration, if the key players aren't necessarily screaming reversal, then does that mean the index too is stable if we just look at S&Ps or the NASDAQ?
Yeah, I mean, for now, we're assuming that there will be a pullback. It seems to be likely for at least the NASDAQ 100, which is so heavily weighted towards those mega caps. So while the mega caps themselves individually aren't flashing any sell signals, the NASDAQ 100, which is a diversified look at those companies, does have signs of exhaustion. In fact, we just posted on this on the daily, weekly, and monthly charts all at once. And taken together, they would suggest that at least some consolidation is likely. And you can imagine that that consolidation probably won't happen without consolidation also in the mega caps. But we're seeing this all as very healthy, potentially within the scope of the long-term uptrends, which still are really supported by positive long-term momentum. So you don't want to get too caught up in short-term moves and rather focus on the longer term, which is still quite bullish for the market. We do suspect that perhaps the second part of the year will be a bit more volatile, meaning choppier, still higher highs, higher lows, but choppier than, of course, we got used to off of that October low, which was really a nearly uninterrupted uptrend.
The breadth hasn't kicked in, though, right? We're still, I described it as a single jet engine. Is it something like that?
It's a good way to describe it. And you're right, the participation really just hasn't been there. So anyone that is not invested in that large cap technology complex or the semiconductors especially, I think they've probably lagged these major indices and frustratingly so. So it does create a more fragile environment, but we're always respecting those momentum gauges over any of the market internals, which would include breadth.
Okay. When you look at the market's relationship with bonds, it seems like some of it is broken a bit here, where a few big rallies in Treasuries, drop in rates, hasn't spurred the rally in stocks, in particular small caps, which have been very tied to it. So what should we do with bonds then? Do we need to spend as much time thinking about that? Do you see that relationship ebbing at all?
Yeah, there's a few things that impact market sentiment, and Treasury yields, of course, are definitely one of those things. The Treasury yields, we track the 10-year very closely, and we feel like it's a sideways to lower environment for yields, which is a corrective move within the context of the secular shift higher that we've seen. So neutral to lower, maybe that kind of action just won't have that same kind of impact on equities that a strongly trending Treasury yield might. So there could be that shift to some degree. But we are buyers of fixed income proxies like TLT or the AGG ETF, and we're buyers because those have built what appear to be basing phases that should hold relevance for at least a few months, if not even up to a couple of years, based on the indicators that we're watching on the monthly chart. So we do think there is at least a corrective move underway there in yields that, if anything, should probably help equities more broadly. It's certainly not, as you mentioned, helping small caps in the short term, but that doesn't mean it ultimately it won't help foster that long-term upside momentum for the Russell even.
So looking at the 10-year, the fact that we cut to lower yields compared to last month, we're making lower lows. It sounds like within kind of the range sideways, there's now that negative bias for yields. It looks like it cracked some of the support in a pretty big way on your chart. What's possible here, Katie? Because it looks like when we've fallen below that trend line in the past, it doesn't last very long.
Yeah, so we're watching something called the cloud model, and the cloud model is very relevant for anything that trades globally and with a lot of liquidity, and it includes rates. So for the 10-year yields, the support based on that cloud model is at 4.13%. There's still room to that level. Below that level, we start talking about sort of the mid threes as a reasonable downside objective for the corrective phase. Again, we don't think this is happening quickly. This is a long-term type of development, and it's still within the context of the secular shift that occurred in 2020. So we do think they're ultimately going to make a higher low, but that higher low could be easily 3.7 or something close to that. So we're watching that 413 level as key support.
Okay, very interesting. Dollar-wise, that seems to be one of the big movers of the week. Is it range-bound? Is it still kind of have a bullish bias? Because it looked like it was going to drop, but every time it does, it just springs right back.
Yeah, I mean, it definitely, if you look at the dollar index, it has very good support based on that same cloud model. So it's been holding up above that level. I would call it a neutral range, as you referenced. And in a neutral range, we can get caught up in the short-term swings, of course. But overall, really, the bias for the dollar right now is more sideways than anything else. So to trade it is a little bit difficult, as you could imagine, because you can't assert this directional bias over any meaningful time frame. So we have a neutral takeaway at this time. There is strong support, but at the same time, within that range, there's quite a bit of resistance.
Okay, so it's kind of pinned, I guess, for the moment. Almost kind of looks like maybe it's coming to like a little triangle, like some kind of head it's coming to or sometime soon. I mean, does it look like it's got a long runway to be range bound like this?
Well, I think we just assume the prevailing trend longer term will persist, right? We don't know what it'll look like in 6 months from now. We just sort of mind the levels, right? Mind the support and the resistance levels. The longer term gauges, the monthly gauges, do mostly point higher still, but I wouldn't be surprised to see them deteriorate. So we'll just keep tabs on that.
Okay. Hey, one more, Katie, to round us all out. Let's talk commodities real quick with crude oil seemingly continuing to get stopped out every time it rallies, but it doesn't go too far also to the downside either. So is it another one that's just stuck or what?
Well, another range, right? And we've seen most commodities lift out of these long-term ranges, which is pretty interesting to me. I think we have a commodity bull cycle broadly underway. Crude oil has not been the source of that, though, and yet we've got some well-defined levels there too that we're watching both on the downside and the upside. Within the range at this time, we feel the bias is higher. So looking for a relief rally within the trading range that crude oil has been bound by, and perhaps ultimately a breakout from that range alongside some of the other commodities that we've seen.
Okay. The ones that went crazy, like copper and broke, did it look like those were hard breaks? Because it was really sprinting for a little bit there, and it seems like that's at least on hold.
The breakouts that preceded the pullback that we have in the metals complex were major breakouts. They have long-term implications, and it's only natural ultimately to see a pullback ensue after such strong gains in price. So we see the pullback as counter trends. It is likely to continue based on our shorter-term indicators, but ultimately we think that will yield some kind of buying opportunity in the likes of gold and copper to take advantage of those breakouts from the big ranges.
All right. Great stuff. Katie, thanks for the analysis. Thanks for your time as always. Appreciate it very much.
Good to see you.
Likewise, Katie Stockton, founder and managing partner at Fairlead Strategies, portfolio manager for TAC. Okay.